Right, good evening, everybody. I'm just getting used to this microphone. I'd love to see a lot of people here this evening at our special meeting with the South Yorkshire Pensions Authority. The venue, I think everybody's been having a nosy outside there. It's absolutely superb, isn't it? It's it's a lovely setting. It's good for the town, and a lot of people are very, very interested in it. However, that's enough of that. The business before us today is that it's a South Yorkshire Pension Fund's AGM, and welcome to our annual meeting. And this is my first meeting as chair of the authority, even though I've been involved with the fund since 2008. I succeeded Keith Gulty, who unfortunately lost his seat this year in the May elections. As Keith mentioned in his introduction to the annual report, the 12 months to the end of March 2014 were another transformational and hectic period for the authority and the fund. Not only did we need to agree with the employers and the actuary, the contribution rates arising out of the 2013 actuarial valuation and handle the implementation issues arising from the introduction of the new 2014 scheme, but we also had to respond to government consultations over the future structures and governance of the local government pension scheme. And all this had to be addressed against the ongoing pressures on local government budgets and saving cuts and ever-increasing demands upon the pension fund as pensioners live long and the bond yields remain substantially very, very low. And the outcome of the actuarial valuation at just 76% funding was not helpful. It was a not helpful outcome, although it came as no surprise to any of us. Keith also referred to the changes in senior management last year, which occurred after the clerk and the treasurer, Steve Pick, retired in March. The new clerk to the authority is Diana Terrace of Barnsley Metropolitan Borough Council, and the new monitoring officer is Andrew Frosdick. And the new treasurer is Frances. Frances is a side of us is also from Barnsley as well. And I'm pleased to say that Frances is here tonight, and she will shortly take you through the programme for today and this evening. I would like to thank Steve for his help last year and my fellow councillors for their continued support. I would also like to record my gratitude and appreciation for the hard work of the fund's officers over the last few months. It's been absolute chaotic and hectic, and they've been brilliant. Looking forward, there appears to be no let-up in the challenge the fund faces. The need to balance the conflicts between affordability, sustainability, and advocacy of the pensions in both the short and the long term is at the forefront of all our minds. And the pressure to meet all these objectives will not go away, and it's with us all the time. What I can assure you is that both councillors and officers will do their best and the very best to ensure that those challenges are met to the fund's advantage. There are just a few words I need to say in the introduction, as we speak a little bit later. But can I now introduce you to now Frances Foster, Treasurer to the Authority. And Frances will just put in a few words together about the programme tonight.
Right, as just been said, I'm Frances Foster and I became Treasurer from April, so this is my first meeting as well, so I'm looking forward to it as much as you are. I'm just going to run through a few housekeeping items, obviously, for the evening. There are no planned fire alarms, but if the fire alarm does go off, we need to go through the double doors and turn right and keep going as far as you can, and that'll take us through, but we're not expecting anything to happen. Just in terms of transport, if people have arrived on the transport that was arranged by the Pensions Authority and you don't want to return on the bus, can you please just let a member of staff know so we don't miss anyone or leave anyone behind? And a reminder that the buses leave at 7:45, presumably where you were dropped off. Again, just for information, the event is going to be filmed and that will be available on the YouTube account from the Pensions Authority. The cameras are going to focus on the speakers, but if you have got concerns, if about sitting at the front and being on camera, if you'd like to move towards the sort of the rear of the room, you should be okay from that respect. Again, you should have all received a survey in the packs that you've got. We would be grateful if you could complete those, and there should be a box outside for you to put those in, or if not, if you hand them to one of the members of staff, we'd be grateful. They'll be really useful in determining how we might sort of make these sessions better in the future. And finally, obviously, we'll finish with a light buffet at the back, just around 7 o'clock, depending how long the meeting takes. So to the actual meeting, first of all, John Hattersley, the Fund Director, I'm sure you'll all know, is going to take you through the accounts in the investment report for the year. That'll be followed by Gary, the Head of Pensions Admin, who will take you through the annual admin report for 2014. And then there'll be some time for questions from yourselves. What I do need to remind you of is that we won't be able to answer questions from your individual point of view on individual circumstances, but members of staff will be available during the buffet if you've got particular circumstances of your own questions you want to ask, or else you can contact the authority. I think all the different contact details are in the packs that you've had. And then we'll hear again from the Chair, Councillor Wooten, just to close the meeting off before the buffet. So with that, I'd like to invite John up to the podium.
Good evening. Unfortunately, this is not my first meeting. I'm sure some of you have the same sentiment. Right. I thought I'd be colour coordinated, by the way. I thought it was appropriate for the ground. As Francis said, we do appreciate you filling in the survey forms. The result last year was a big enigmatic. Quite a few of you said I spoke too long. Some of you kindly said I didn't speak long enough. Some of you said I didn't give enough detail. Some of you said the quiz was too long. So basically, I've ignored you all. I'm going to do my own thing. This slide, which again is in your pack so you can see more clearly, is a summary fund account as at the end of March 2014. It's been compiled from the audited accounts included in the annual report. If you really feel bored one of these dark autumnal nights, the annual report is a cracking read. It's only 108 pages. If you need something to get to sleep with, it's really recommended. The annual report is on the authority website if you want to go back and look at it later. Summary accounts. The first thing to notice is that the contributions and transfers received rose only by 3 million to 232 million, whilst the benefits payable increased by more than 10 million to 250 million. Therefore, there's a direct shortfall between the contributions received and the payments made. That, of course, is not surprising for those of you who've been here before. Of the 220 million received in contributions, 167 million came from the employers. 149 of that came from the 4 district councils. 53 million came from members. So basically, 3/4 of the contributions come from employers. Again, that's similar to last year. Of the benefits payable, 183 million is direct pensions. The balance is basically lump sum retirement and death benefits. The biggest increase last year was in pension payments. So how was the shortfall in expenses met? You can see from the table that investment income was positive. It rose from 131 to 150 million over the year. The major increase in income actually came from company dividends, share dividends, 98 million, and property rents, which went up to 17 million. In contrast, the income we get from bonds fell slightly to just over 24 million. The change in the value of investments was again positive. This produced an increase of 138 million. The larger improvement in value came from equities, i.e. company shares, and property, whilst the value of bonds actually fell by some 50 million. You'll see again costs. The increase in admin and investment management costs included increased actuarial fees, not surprising when we had an actuarial valuation year, and an increase in our VAT liability of about £65 million. Employee costs fell marginally. Now, when you add all these constituents up, you can see there was a net increase in the net assets available for investment of £263 million. That brought the fund's closing value at the end of March to 5.55 billion. Since March, we've seen quite a sideways movement in investment markets, with a bit of going up and a bit of coming down. And at the end of September, the fund was valued at 5.77 billion. Now, the valuation at the end of March places the fund in the top 50 of UK pension funds, and we rank 7th in terms of assets within the local authority universe. So how did the fund achieve those returns? And what sort of shape was the fund in at the end of the year? This slide shows the fund's investment return compared to the benchmark and the consumer price index over 1, 3, 5 and 10 years. The fund outperformed its benchmark, returning 5.7 versus 5.4 last year. And although the 3 and 5 year numbers are still affected by the aftermath of the 2008 crisis, the fund is ahead of benchmark over the 10-year period. There have only been 2 years out of the last 10 when we did not hit our benchmark target. And those 2 years were 2010 and 2012. The former was due to the failure to capture the bounce in equities after the crisis. And in 2012, again, we held too many bonds and too much cash. They are weaknesses, and you can't explain away performance just by saying they're weaknesses, but basically they stem from our inherent caution. Our prime role in life is not to destroy capital, and we're always very conscious of that. However, as I've emphasised, over the years, the benchmark, which is tied to our own liability profile, we have beaten it 8 out of 10 years. Now, if you've been to these presentations before, I go on about the fact that we have our own customised benchmark which reflects our liability profile. And that is very important. Our fund has always been relatively mature compared to other local government funds. And as a consequence, we have more of our assets in protection classes. That's new actuarial jargon. Protection and growth assets are the buzzwords now. And protection classes really mean bonds. Bonds because they're usually less risky than equities. They hopefully produce a steady income, and are so more suitable for pensions funds that require predictable cash flows. Now, according to State Street, who are an independent analyst, the average local authority fund last year had roughly 17% or so in bonds, compared to your fund's allocation of roughly 20%. Now, that difference doesn't seem a great deal, but the amount of money we're talking about, $5.5 billion, it soon adds up. And one of the consequences of having more in bonds is that we tend not to perform as well in years when equity markets are strong. And last year was one of those years. The average fund equity performance last year was 8.4%, whilst bonds returned a negative 1.6%. So although we outperformed our own benchmark, we can't beat those sort of inherent numbers. As a consequence, the fund didn't meet the average local authority return last year of 6.4%, but over 3 years, we remain ahead of the pack, producing 8.2% compared to the universe return of 7.5%. Moreover, 8 years positive performance out of 10 is a very enviable record, and State Street's independent analysis shows that fewer than half of UK's pension funds have actually outperformed their benchmarks over 10 years. This slide shows how the assets were held at the end of March. As you can see, the fund had over 60% in equities, i.e. company shares, with 20% in bonds, and the balance split between real estate and alternative assets. Alternative assets are primarily private equity and absolute return funds. Private equity is the asset class which normally provides finance to small and growing businesses, although it can also be used for what we know as large management buyouts and so on. Whilst over time the returns tend to be better from private equity than from listed companies, you are locked in when you invest in private equity, usually for 5 to 7 years before you get your return. And during that period, of course, you don't have your access to cash. They're what we call an illiquid asset. Clearly, being illiquid is an impediment when crises arise or when you need cash. So it's prudent not to have too much invested in classes like that. But our private equity portfolio is doing very well at the moment. It has done for the last 2 years, and is actually throwing off more cash as our investments redeem than we're actually putting in at the moment. As I've already mentioned, the investments in bonds are included to try and produce secure, steady and repeatable income. Unfortunately, whilst they are relatively safe, they are susceptible to inflation and will lose value over time. So in order to participate in economic growth, pension funds invest in equities, which are shares in listed companies or those quoted on stock exchanges. Equities offer investors access to earnings growth and increasing dividends if the companies are successful. If they are not, and they fail, of course investors risk losing their capital. It is rare for a bond investor, on the other hand, to lose capital, although issuers can default. And some of you may have been reading the press about Argentina at the moment. As always, it is a balance between risk and reward. But as the chairman mentioned in the introduction, the actuarial valuation at the end of 2013 showed the fund had a notional deficit of 76% funded. That is the largest notional deficit we ever had. I don't want to get worked up about it because it's just a deficit at one day in 1 year. But in order to recoup that deficit, bearing in mind all the constraints of our employers are facing, we do need to enhance investment return. And I'll come on to that later. The fund is basically split between 33% in UK equities and 66% in overseas equities. This is a higher weighting than most comparable funds, but part of the reason for our decision is that you have to bear in mind that 80% of the earnings of the UK's largest 100 companies come from overseas anyway. So when people talk about the FTSE 100 index, it does not necessarily represent the state of the UK economy, because those earnings are coming from overseas. This slide shows in greater detail how the overseas equity portfolio is invested. There is a bias towards the Asian and emerging market economies, where we think the longer-term prospects of growth are better. Ironically, over the last couple of years, the developed markets, i.e. Western European and North American markets, actually outperformed. But recently, that trend has reversed, notwithstanding all the geopolitical conflicts we hear about. In Asia, Japan remains a bit of an enigma. The positive action you may have read about from Prime Minister Abe to stimulate the economy through a lot of monetary measures, he's printing money like there's no tomorrow, has only been half successful so far. He's desperate to try and get inflation taking off in that economy because for years Japan has suffered from deflation. Minor reforms are taking place behind the scenes, and it was interesting that we had an announcement from Sony, the big electronics maker, but for the first time in living memory, they've decided that they will no longer pay wages just due to length of service and seniority. They're actually going to tie wages now to productivity. And that sort of corporate change in Japan is extremely unusual, but it is beginning to take place. We added to our position in Japan over the last 12 months, but we are still underweight. We are still waiting to find out whether Abe's reforms are successful. There is a bit of political resistance in the country, but it is a very large economy, and it's not one you can ignore. What were the broader features of the last financial year from an investor's perspective? Sometimes mere survival is underappreciated, and last year was one of those times. Investors and financial markets were still trying to work through the consequences of what so many people call the exuberance of 2008. We should never forget just how traumatic and how important the crisis that was. The massive amount of financial stimulation provided by the central banks remains a driving force behind markets. And although there are now tentative signs of gradual recovery in many of the developed economies, particularly in the United States, when the uplift is placed in longer-term context, the extent of the response remains disappointingly weak. As the year progressed, concerns grew, and not only was the recovery relatively lukewarm, but it was also very patchy. The advanced economies were performing better than the emerging ones, and there were signs of imbalances within the global economy. Behind the improvement, however, was a growing recognition that investors had to prepare themselves for the inevitable withdrawal of all that financial stimulus. You'll have heard the papers being full of the QE, quantitative easing. This is whether it's taken place by the Federal Reserve in the United States or by the Bank of England over here. It's a system whereby the central banks pump the economies by putting money into it. They either buy back bonds or put pressure onto their own balance sheets or simply print money. It's sovereign debt, to put it crudely, and the idea is it percolates through the system, lubricates the wheels and gets things moving. It reduces some of the logs and contractions within the financial system. The consequence of that is A, we're not quite sure whether it works, and B, is how you get all that money back out once you've pumped it in. It's a bit of an experiment, and we haven't quite found out the answer yet. Consequently, we were light in bonds, i.e. we were underweight. We didn't have a full allocation in bonds during the year, especially bonds issued by sovereign governments, because the yield was so low. If I wanted to invest in a UK government bond at the moment, I would be paying to invest with them. I get a negative real return if I buy a 50-year government bond. Okay, it's safe, but why should I buy a negative yield for 50-year government bond? So what we did instead was switch between high yield and emerging market bonds, where we thought and got higher yields, of course trying to make sure that our money is safe. We also put more money into the private equity portfolio, and that continues to prosper. We increased our allocation to overseas equities because we think that's where the growth is. But as the year progressed and the belief that neither fixed income nor equity markets were fully adequately pricing in the potential downside risks, we added money to the property market, again as the signs of recovery came into property. And we also put money in when it became clearer that the recovery in London in property was not just limited to London and the South East. Now, apologies for this chart. I know it's a busy chart and it's easier to see in your handout, but for a broad comparison, this is very interesting. It's probably the best we've seen. It shows how the asset allocation of pension funds, insurance companies, and investment trusts has changed over the years. You can see how, as funds mature, less and less is being invested in equities. They have fallen from a peak in 1997 of almost 47% to about 15% in mid-2011. I've already mentioned our weighting in equities, so you can gauge where we are in terms of allocation against the universe. During the year, members undertook a thorough review of the fund's responsible investment policy. This was partly in response to overtures received from some specific pressure groups, but also because members wanted to be sure that the fund remained in the vanguard of this important topic. Members discussed the subject thoroughly and reiterated the authority's belief that it is more responsible for a long-term investor to engage with the companies in which it invests in order to effect change than it is to divest from them. We also believe that companies that observe sound corporate governance tend to produce the best shareholder returns over time. Companies that are better managed in the boardroom tend to be better managed all the way through. Now, As you know, the fund had some deposits with Icelandic banks. I'm pleased to report that roughly 17.3 million out of the outstanding 18.5 has now been recovered, although some of that money is still held in Icelandic krona in Iceland. The biggest creditor of the banks involved remains the London branch of Kaupthing, KSF, and that is in administration. But we had a letter from the administrators this week saying that we're going to get another dividend in December. Looking forward, it's expecting that the challenging market dynamics will continue for some time, but our approach will remain the same. Namely, we aim to deliver sound, cost-effective investment management in accordance with long-term horizons and the requirements of the fund's liability structure. Whilst we acknowledge that to be around for the long term, we need to perform in the near term as well, and yet that performance has to be strong. It ought to be remembered that the skill in investment management lies in not being blown off courses by patches of turbulence, but instead to focus upon meeting the needs of the fund. Now, I have two further observations to make before I test your knowledge with tonight's super duper quiz. Firstly, since the year end, and indeed before it, members and advisors have been reviewing the investment strategy in light of the outcome of the 2013 actuarial valuation. Despite the good investment returns over the 3-year period, the increased cost of our liabilities has increased that deficit to a record level. So although investments outperformed expectations, the very low bond yields, historically low bond yields, which are what the actuary uses to measure your liability costs, exceeded that. As I've said, pension fund investment is long-term view. And although that review in terms of asset and liability is ongoing, basically the view is that no big changes to strategy are being advocated. There will be some changes to the way in which we manage the UK equity portfolio going forward, and we will revamp the corporate bond and alternative asset exposures. The intent is to enhance income without damaging or loosening our risk controls. The second observation, and something again the Chair alluded to, is that over the last few months the authorities responded to a number of government consultations. In particular, there was one on collaboration and opportunities for cost savings in the LGPS. This received some headline coverage in the popular press, claiming that hundreds of millions of pounds could be saved if we did X, Y, and Z. The difficulty of those estimates was it was done at a very top-down headline level and failed to take account of the better performing funds. If the suggestions in the questionnaire, the consultation, were followed, it would adversely affect all the better performing funds in the LGPS, and that includes yours. We estimate that if the fund had been forced to invest along the lines advocated in the consultation, i.e. moving away from active management into passive and using collective vehicles rather than single funds, over a 10-year period up to 2014, it would have cost your fund roughly £100 million in performance. The consultation also ignored the fact that internally managed funds are cheaper. You don't pay us enough. But we're also more responsive. We are in-house. We understand what members are wanting. We are quicker to react. But equally, we tend to take a longer-term view. We're not being run by an external manager who has to justify their fees every quarter. So we can afford to sit back and look at things and take a long-term view. And all the research supports the idea that internal funds produce longer, better returns than externally managed funds. I'm pleased to say that we were not alone in responding negatively to the consultation, and although all the evidence is anecdotal, most of the responses were extremely negative, and it would appear that the consultation has been put into the side grass until the next general election. Can I just end up on one key point? Independent research shows that over the last 20 years, the average LGPS fund has achieved a return of close to 4% above inflation. bearing in mind that our job is to pay pensions, I don't think that's a mean achievement. Thank you. Quiz time. I thought I'd try and steal some of Gary's thunder and point out some of the problems he and his team face. So 4 of the questions today are about pensions admin challenges. Changing addresses. It's very important that when you move, you let us know that you moved. It's obvious, but many people forget to do it. What percentage of the UK population, on average, move house each year? 6.5, 8, 11.5, 12, 13.5? You choose. How many marriages are there in the UK per year? Again, if you get married, it's important to tell us, because it will affect your benefits. How many UK pensioners live overseas? That's not how many would like to live overseas, it's how many live overseas. The other sad point about pension administration is deaths, of course. Slightly tongue-in-cheek, but are the following animals which kills the greatest number of people on average per year? I should say, of course, it is working on an average year, bearing in mind the conflicts taking place in the world, maybe the human numbers has to go up. But which of those animals kills the greatest number of people on average per year? And the final quiz question. This is an investment one. We all know about the housing crisis. We all know housing values are going up. There's a shortage of new housing. We hear it all the time. In 2009, the stockpile was 887 million bricks. At 10,000 bricks per new house, that's only roughly 89,000 houses. We all know that's not enough. So in September 2014, what was the stockpile of bricks in the UK? Thank you.
Better turnout than last year. Hands up, who's come for football ground? I knew there'd be some. It is a nice football ground. Oh, going backwards. That, in case you're wondering, is a perfect storm. I searched perfect storm and that's what came up. I got pictures of George Clooney as well for some reason. But perfect storm. And that's, I don't want you to feel sorry for us, but we've had a busy year. And it's been quite a busy year for a number of reasons that I'm going to explain to you. And perfect storm kind of fit because we've done a number of things this year that perhaps you wouldn't do all together if you got any sense. But we had to do them and we didn't really have a choice. And I'll explain that. But so I'm just trying to just work around the perfect storm angle and hopefully everything will become clear. But it kind of puts into context what comes after it when I start talking about the performance figures and the review and the workload and everything else. So it kind of fits together if you bear with me. So first of all, we've got Mercer. Now Mercer, in case you don't know, are our financial advisors. Basically, they help us deal with the financial aspects of the scheme in terms of the actuarial valuation. John's mentioned that, and we've been through this in the year up to 31st of March 14, which resulted in new contribution rates going forward from that point in time. I'll not spend too long explaining what actuarial valuation is, but it's basically just ensuring that when you look at what benefits have got to be paid and what's in the fund, what needs to be paid by the employers for the next 3 years going forward, in order to ensure that the challenges and the amounts of money that are required are actually met during that time. So leading up to that point, we have to get all the data in from the employers at the end of March 13. and package all that up and send it off to the actuary, who then, when that's all been done, works out exactly how much money is required for each employer, and then we give them the bad news. And then that's when the fund starts, because of course all employers particularly don't want to pay any more pension contributions, and where the fund was at the point in time at 31st of March 13, they definitely needed to be paying more contributions. So we needed to consult and discuss with the employers the requirements for the scheme going forward from 1st of April 14. And that's what we did. And it's with the amount of employers we've now got, and you'll see the slide later, you know, over 300 employers, it becomes a bit of a challenge then when you've got to be looking at each individual employer and giving them bad news and then discussing with them what we can do to try and ensure that they're happy with the payments that need to be made to the fund for the following 3 years. The headline results are basically a future contribution rate that is paying for the members that are in and all the future membership that they're actually going to have, an increase of 0.8%. Doesn't really tell all the story because that's made up of a number of things, and one of those things is LGPS 2014, which the new scheme has been brought in to be cheaper. And in some cases, with some employers it was, in others it actually cost more, because if they had older members then it could actually cost more because they have protection under the old scheme and it becomes more expensive. But essentially a reduction for most, but then over time there's the cost of paying the extra benefits as well, and it resulted in an overall increase in the normal contribution rates. John's mentioned the funding level, and at 31st of March we were 76% funded, and basically a shortfall of about £2 billion. You just love how we just trot out these big numbers. It's incredible, isn't it? I mean, with 600 million here, 200 million there. It's just amazing. It don't really mean anything, does it? But in essence, that is what was required as a deficit at that point in time. We can use a bit of license in the valuation process, and 31st of March 13 was not a good day. You do the valuation on a day, and that is how it's supposed to be done. And 31st of March certainly weren't a good day. You're allowed to move it forward to within reason to take advantage of any improvements. And as you can see, by August we'd improved the funding level up to 80%, and then further by December to 82%. The financial world was changing for the good side at that point in time, and we ended up in December 13 with the 2 billion coming to 1.2 billion pounds in deficit. As John says, that is not really to start panicking about. It's something that is there with lots of pension funds, and as long as you've got a plan to recover, then that's fine, and things can change rapidly anyway. The recovery period for most employers, not all, but most employers within the fund is 22 years. So it's like paying a loan off. So in addition to their 12.8% that they're paying, they're also paying an amount of deficit recovery sum that's added to their contributions, and they have to pay that over the next 22 years. So it's like having a big mortgage, basically, that they're paying over a period of time. Apologies, but I neglected to, well, I did this slide late, and I neglected to hand it to the people who were doing your printouts, so you won't have got this on yours, so you just need to look at the screen for this, but feel free to write it down if you're at all interested. One of the things just on the valuation that, to put the results into context, we were saying that where employers were in deficit, and that statistic says 81% employers had a funding deficit, whatever came out of the valuation, we went in with a premise that nobody paid any less than they were paying in the last valuation period. So nobody actually took a cut in contributions at the valuation. Some stayed roughly the same plus pensions increase, but essentially nobody could have a reduction. So we were looking at 81% with a funding deficit. So these are just a few stats. There's loads of things I could throw at you, but just a few things just to give you a flavour. 73% of the fund who are currently paying in is female, and I think if you've been here before, I've been through that kind of thing before, when we look back to the 1970s, how different that was in those days compared to now. It's a high majority of the scheme members are female. Life expectancy is always a good one. I like this stat. I wish I was still 45 now, but if you're 45 now and you retire at 65, then you've got a 25 years life expectancy if you're a male, and 28.2 years if you're a female. So that ain't quite bad, is it? If you live to the averages. Retirements in the valuation period, 55% of retirements were voluntary. So it kind of takes away from the fact that, oh, everybody's been made redundant and so on. It's voluntary retirement is still the majority. The other categories, you know, register decent numbers, but 55% were voluntary. The one that's increasing the most, it's not high yet, is late retirement, where people are working beyond 65 and carrying on right up into the 70s. So that's one to watch for the future. Talking about big numbers, this ain't one. In terms of the average pension in payment, it's only £4,400 a year. So that is still, it's stayed around that for some time. And whilst it's been low pay growth in local government over the last few years as well, it's likely to stay like that for a while. And 9 pensioners are currently over 100 years old, which is again an increasing statistic, and the number of centurions that we have. Any guesses how old the oldest one is? 100 and what? 108. 108. It's a lady, not surprisingly. So that's the valuation. So that's one component. So that's kept me quite busy. LGPS 2014. I mentioned this last year, and I went through the features. I'll not do that today, because we've done that. Just what we've been doing in relation to our GPS 2014, just to give you a flavour. The first thing we were doing in this review period is looking at the consultation we were being consulted with, because the government were giving out the proposals and we were then required to comment upon them. So we ended up with all the draft legislation and said what we thought and took a blind with the notice, but at the end of the day, that's part and parcel of the process of the new scheme coming in. During that time, we were then communicating with scheme members, because we had to warn them what was coming and prepare them for it, and communicating with employers. We had to start developing internally new procedures, because there are different benefits, and we had to create things that ensured that when those came into the office, we could deal with them, and we had procedures for them. All our software had to change, so we had software updates and calculations, and believe you me, the calculations are difficult, and some of the software updates we didn't get until after April. So when the scheme came in, so in the early days, we're back to when I started on pen and paper, having to do calculations manually because the system wasn't up and running. We tested those, and it is now up and running, I understand, for the majority of cases. And we had to do new letters. If you retired today, say it with me, who's been in the scheme since 1978, I would be writing a letter that said, you've got benefits up to March 2008, and that's based upon a 80th accrual and a 3/80th lump sum. You might remember that from when you retired. From 1st of April 2008 to 31st of March 14, I've got a 60th pension, no lump sum, but I can give up some pension for lump sum. And then from the 1st of April 14 to my retirement date, whatever it will be, I've got a 49th accrual pension, and I can give up some of that for lump sum. We've got to put that in your benefit letter if we were sending it to you. We've got to explain it to the members so that they understand what their bottom line is how it's arisen, and that it's going to be accurate. And doing that in a way that's easily understandable is not very easy. That follows into training. We had to ensure that all our staff were trained, because the phone rings and somebody wants to know what benefits they're going to get or what the changes are and so on. And we had to put all the training in to the staff. We then had to talk to the employers, because they're just a bigger part of it as we are, and there's 300 none of them, and they have got roles to play in making sure that the right contributions are collected, they're paid across to us on time, and that the benefits that they are awarding are the right benefits and they're correct. So there's an extremely important role there in ensuring that employers are aware of their responsibilities. Unfortunately, or fortunately if you remember, but unfortunately for us, all the members who joined the new scheme, that is, who were there on the 31st of March and then joined the new scheme on the 1st of April, all got some protections. You got protected on your final salary for when you come to retire. So you get two parts of your benefit. You get a bit on the old bit and a bit on the new bit. If you were within 10 years of retirement in 2012, you got something else that said if the old scheme was better than the new scheme, you get the old scheme, and so on. And all these things had to be taken into account too. And if that weren't bad enough, all the old schemes are still running. So if you retired prior to 31st of March, your benefits are calculated on the scheme that was in force when you actually left. So we have to keep that going too. So it's just a flavour, but that's the kind of headache that we've had to do to put into LGPS for 2014. There's still things that are coming. We do a set of amending regulations which will correct some errors and put some things in that were missing. There'll only be minor things, we think, but again, it's still not 100% there, and let's just hope it lasts longer than the last scheme did. The last little bit is the thing we wouldn't do if we had had the choice. Civica is a company that are selling us a new pensions administration system. This has been brought about by our existing supplier not wishing to tender for the work and wanting us off the current system by the end of December this year. So we've been driven to replace everything that we've got, everything that we know, with something new. And we're doing it as we speak. And it involves documents coming in, scanning them in and indexing them to make sure that we know who it belongs to and it goes to the right person. It means moving every bit of every member's record from one system over here to another system over there, but things aren't in the same place and they're not called the same names and things like that. So you're moving everything in and you've got to make sure everything is right. All the calculations, ordinarily that wouldn't be too bad, except we just did it in a year when all the calculations were changing. So it's an added complication. Workflow that says if you got this case, you do this with it so that staff know how to deal with it and so on. That needs developing. Our performance statistics need to come out of it. As you know, we pride ourselves on our performance and the amount of data that we can actually say how we've performed on so that we can clearly demonstrate what we're doing. If you're on pension, you'll be interested to know we're getting a new payroll and we'll need to be paying you on that payroll on the 24th of November, so on November payroll. And it needs to feed into the accounts so that we can balance the books and produce the accounts that we send out to you in the annual report. We also need new online facilities. The existing online facility for active members had to be taken down because our existing supplier wouldn't put the new calculations into it. So we need to get everybody back on board with that as soon as we can. That won't be ready for 24th of November. That will be ready sometime next year. But that is our go live date, and pretty much we've got to do it then. So that, as I said, that is really a busy year for us. Those of you who've been before, I think you've seen me and you've talked to me. You'll probably get that I'm reasonably calm and cool and not too stressed about things or anything like that. That's me. But it'll all come good. It will all come good in the end, I promise you. Just to pick up then on the annual review stuff that you will have got from the annual report and in the pack. So this is the familiar stuff that I tend to do. You'll see the membership, total membership always increasing. So that graph at the top always increasing, regardless of whether people leave or not, because they go into the other categories. But over the3.59% increase. Active membership at the 31st of March had bucked the trend. It had been going down, as you can see, since 2010. Actually went up for the first time by 0.18%. But as I looked at the end of September, it had started falling again. And I think it had just had a boost by auto-enrolment, perhaps, as I mentioned last year. But overall, nothing too significant on the membership numbers. Not masses of leavers throughout the year, but a typical pattern as we've seen over the last few years. This is the one that's trying its best to get off the top of the slide, is the number of employers. 267 as at March 2014, currently 290 with a further 78 in the pipeline. Currently 362 employers in total. The reason, as I've said before, is the shift of schools from local education authority who are part of the council into academies who are then running their own show. And when they do that, from a pension point of view, they become a separate employer and do everything themselves as an employer would. That brings challenges, of course, because we have more employers to deal with. And at the moment, it's showing no signs of slowing down. Our performance won't be this good next year, promise you. But the performance in the year to 31st of March, 32,668 cases, which was more than we did in the previous year, a good 4,000 more. But the performance level was the same, 99.7% within target. So, as I always said, that's really pleasing. We hit the targets, we do things when we say we're going to do them, and we do it regularly. The number of complaints, nothing significant here, a low number, very small percentage of total workload, nothing particular about all of them, a range of different things, but those are the complaints that we dealt with in the year, along with one internal dispute. In terms of overall satisfaction, every survey we send out, we ask if people are satisfied with what we do, and hopefully there's one on the survey that you've got to fill in tonight. Employers on the surveys that we issued during the year were 100% satisfied, and scheme members were 96% satisfied overall with the service that they got with us. So it's a good high number that we're achieving. We benchmark ourselves, and again you'll be familiar with this year on year. This always goes out of sequence because of when the benchmarking results come. So this is the one, not the one in the annual report. This is the one that is current and for the year that we're looking at to March 14. 49 pension funds took part, and our cost per member, so how much do we spend on each individual member for the service that we provide, was £19.62. And below the average line at £20.75. So, and that's good, because we feel that we provide a high quality service for a below average price, and we've done that and achieved that 11 out of the 12 years that we've participated in the survey. So it's consistent, and we're pleased with that kind of result. Just we were talking about employers, and if you compare us to the average in the benchmarking, we've got a damn sight more employers than a lot of funds have. So we've got 362 while the average is 180. And if you think that's an average, there's some that are quite a lot lower than that. I put this stat on because I'm going to refer to it later, so just remember this. But when you retire, you can take part of your pension as lump sum. You get an automatic lump sum for part of it, but then you can add some more to it to take it as tax-free lump sum. So you give up some pension for lump sum. The average in South Yorkshire Pensions Authority is 81% of people do that and take their lump sum as a maximum that they can take. The average is 56%. What that tells us is in people in South Yorkshire like the money in the pocket, which is probably stereotypical, isn't it, for Yorkshire people? But and I can say that because I'm from Yorkshire. But essentially, we like cash. And just hold that thought because I'll come back onto that. So around the corner, what's coming? Well, I've mentioned UPM, Universal Pensions Management, already. But for us, that is an important thing, because once we've got it live, we aim to develop it. It's a system that allows us to go to town with what we can do with it. And it certainly will make us even more efficient, and we'll be able to bring improvements to you in the service that we can deliver from it. And so certainly that's something that is on our minds. Governance is one that may be of interest to you. All public sector pension schemes, and LGPS included, having to create local pension boards. And the local pension board will sit above the Pensions Authority and basically scrutinise what we're doing to make sure that we're doing it properly, and to make sure that our councillor members are asking us the right questions as officers as to what we're doing, and to make sure we're administering the scheme correctly and we're efficient and so on. And the board will be made up of scheme members and employer representatives, and it will meet on whatever occasions, because we don't know the fine detail yet. And it's coming from April 15. So you may find that if you're interested, you may want to put in an application to be on the board and play a greater part than what you're playing now. We need to get the detail. At the moment, we've had some draft regulations which didn't tell us very much, and we're now expecting some more some regulations that are going to come with some guidance. But it's coming, and it's around April 15. So this time next year, I'll probably be able to tell you how it's going, and we might have somebody, one of you that's on the board, that can tell us as well. But that's certainly in the offing, and it's coming. Cost sharing is a way that's been talked about for years. It's been in regulations, but we've not actually had the detail. And it's a way of adjusting the scheme when employers need to pay more money than is actually a limit that they get up to, that they shouldn't pay over. So if employer contributions through evaluation were said to go up so far, at the point that happens, the scheme can be adjusted. Either the scheme members pay extra contributions, the ones who are still paying in, or the benefits that are being paid could be reduced. And this is coming now, so we will get the detail on that, and there will be a trigger point that comes that says employer contributions go up to a certain level, then at that point the scheme has to change. And this is really just, as it says, cost sharing, to share the burden between what employers have to pay in and what the scheme members have to pay in. Now, speaking about cash, there's freedom of choice in pensions. Now, I don't know whether you've picked up on this, but this is a countrywide initiative from the government, which basically says, if you want to, instead of actually taking your pension, you can take it all as cash. And provided you're of the retirement age to be able to retire, but you would be able to, in our scheme, transfer your money out to a personal pension provider and take all the money that's gone in there as cash, instead of receiving it month on as a pension. So effectively you could take the money and run. And given our experience, then perhaps that might be what occurs. Again, we still need the fine detail, because there may be restrictions on just how you allow people to run off with the money. But the pensions minister kind of made it clear when introducing this, because he said, basically, and I'll paraphrase that, if you want to go out and buy a Lamborghini with your pension, then fair dues, you can do it. The fact that might mean that you just blow all your pension savings and then you have to live off the state is another matter. But this is certainly coming, and if you consider, as I've said there, that the max lump sum out of the scheme, that ours is 81% like cash, then you can imagine that people are going to be knocking on our door saying, I want to take my pension. So we wait and see with bated breath, and as I say, it's fast and interesting times. You think of a catchphrase for that? I kind of think, well, I shop at Aldi, but I think that could be Aldi car park on a Saturday afternoon in Barnsley. Sorry? Yeah, it is, yes. And finally, for those of you on pension or deferred pensions, your pensions are due to increase on the 6th of April. Sound like lottery man here. Early indications are that it's 1.5%. It's not necessarily going to be 1.5% because that's August. And the rate that we use is based in September, and it's a reducing trend. So it could be slightly different, it could be slightly lower, but it will be around 1.5% anyway. So I think that's my last slide. So it'll be questions next, and I'll stay here for questions.
Okay, Gary, thank
I think somebody's moved. Yeah.
Are you coming?
And Joel sorted that, yeah.
Right, thank you for that. Our two excellent presentations from our two guest speakers. Now it's your particular time of the proceedings, and it's your meeting now, and it's questions from the floor. I understand there's been some written questions handed in already, but everybody will have an equal opportunity or ideal opportunity to ask whatever they seem to think they need to get answers to. Right, so can we start off then with the first question? Has anybody got that? Yes.
My name's Jackson. It's regarding the asset allocation slide that you showed. It just doesn't add up. It's not 100%. The actual calculation is 100.1. Could you explain that, please?
Well, it's almost certainly rounding. Apologies for that. But that's what it would be. It's rounding.
Right. Yeah, the gentleman down here, please.
Yes, thank you. My name is Michael Clinch. I'd like to talk about the way the chairman was appointed. It seems to have been a shoo-in. What I can understand in what's happened in Rotherham over the last few months is an absolute disgrace. If Councillor Wootton doesn't know anything about what was going on, well, he's ignorant of his own patch. If he did know what was going on, he's an absolute disgrace, and I don't know what he's doing sitting there. I'd like to know how he was appointed. I'm sure it's a nice little earner, but why was this allowed to happen in the circumstances Rotherham finds itself in today?
I need to inform you that this meeting is about our performance. It's about pension, about pension matters. I am not in the position, and I will not allow it at this moment in time, to go into what's happened, in great detail. It is not fit, it is not right, and it's not the proper time. However, if you want to speak to me privately and individually, I will take that opportunity. You can either come to my office, I will go to yours and explain what the situation is. Regarding how the chairman is appointed, I said in my introduction that I took over from Keith Gilty. Now, what happens with joint authorities within South Yorkshire is Rotherham takes the responsibility of pensions, Barnsley, as it's done, it takes it for fire and rescue, and Sheffield has the responsibility for police and police matters. And it's normally follows that particular routine. And the reason why I was appointed the chairman of South Yorkshire Pension is because my standing in Rotherham, and in particular on pensions, I've spent about 6 years, with various chairmen within the authority. Regarding what's happening in Rotherham, it is sad. It is really, really unfortunate. I can only apologise emphatically about what's happening. I can't say and will not say in great detail what's happening because there's various organisations and various people are in the authority now doing investigations and also interviews. So it's not right for me to go into further details about that because it may be sub judice and we don't know what's there at the end of the day. Only to say that it saddens me that about the findings of Professor J, and we will do everything possible to try to work with the agencies to bring about the justice for our fragile people, our children, their families, their friends, and it is absolutely a trauma for everybody concerned. Deep regrets, but it's happened, and that's as much as I want to say, sir, at this moment in time. Can I move on to the next question, please? Is there any more? Yeah.
Thank you. My name's Glyn Boynton. I'm an employee of South Yorkshire Police, but I'm not a police officer, never have been. I've asked this question of Gary at a recent meeting, but I think it might be helpful for people to know. Obviously, if we move towards the situation of people being able to take their pension pot, which I think we all thought was a bit of a surprise for local government. We knew it was for private schemes. What's your view on any potential adverse effects it may have on the fund? Because clearly people who are in receipt of pensions or wish to be in receipt of pensions would have some concerns about that. Thank you.
At a reasonable level, it's beneficial for the fund because people taking cash out will probably not reflect the actual liability that they would have had they remained on pension. When people do convert pension to lump sum as they can do now, and that's generally good for the fund. If it became a run and we had an avalanche, then clearly that wouldn't be beneficial from a cash flow perspective. But we're expecting that there should be some measures that will reflect the funding nature of the pension fund at the time that the transfers are being made. What we're expecting is if your pension fund is underfunded, then there will be an adjustment perhaps to the transfer that you would actually pay out. So you wouldn't pay the full amount out, you'd pay an amount reflective of the current state of the fund. And we do need the detail. I wanted to share that with you today because by the time we meet again, it will have already been in place. But we do need the detail. But generally, if it's if people look at it reasonably and it's just another option that people can do, and we don't know at this stage. I mean, I've used the statistic about cash, but really don't know what people will make of it. Then it should be okay from a funding point of view. It just depends as if there's a major rush. But of course, we're also expecting that somebody will have to be finishing work to take it as well. They'll not be able to just stay in work and take the money because they're over 55. Because I might put my hand up for that then. But essentially, they've still got to be thinking that they're retiring anyway, and the retirement benefits that they would calculate still have to be calculated as they would if they were drawing the pension, and it's that you would then convert to a lump sum. And retiring early just voluntarily comes with penalties. So again, it might not be as bad as we expect. But from a funding point of view, if there ain't too many, then no problems.
Can I just add there, Gary? I'm not supposed to give you personal investment advice, but you'll get articles in the press when this story breaks. And in 99.5% of cases, it is not wise just to cash in your pension. Yeah. But the short-term temptation, the idea of going around the world on a cruise you promise yourself is extremely tempting. But as we see on this slide, people are living longer. You need that security of income to see you through your old age and all your expenses. Just think about it. Any of your friends who are thinking about taking cash, just caution them. Ask them to be prudent. Take independent advice, because in almost all cases, it is not the sensible thing to do. I can't comment upon that. Whilst I'm speaking, one of the questions we were asked from the survey, or the written questions, was the consequences of the Scottish referendum on fund investment policy. I suspect it was written before the announcement of the election took place, but it's still an interesting situation. Clearly, there are fissures within the economy which we can see as a result of that. One of the big concerns, had the vote gone for independence, was the amount of debt within the UK and who would support it, who would guarantee it, and so on. And it has heightened that debate, just how much personal debt we still have individually and as a country. And it was interesting over the political conference season how some spoke about and how others didn't about the size of the deficit and how it's been reduced or it hasn't been reduced. And it is, again, something to think about, that bearing in mind we have one of the best performing economies in Western Europe, our personal debt levels are not being addressed. That just adds ask one or two questions. There are fundamental problems still within the UK economy. We're probably not as badly off as Western Europe, but it does mean that investors overseas have started to look more at the UK balance sheet. They have started to look more at the strength of the pound. And of course, cottoning onto the fact that if we want to have an export-led economy, which we're still not achieving, when the rest of the world is slowing down, who are we going to be selling to? So the big issues are still there, they're floating around. There are fewer to answer after the vote went to stay together, but part of that debate was very interesting.
Right, is there any further questions from anyone?
What's
yes, sir.
live streaming?
I beg your pardon?
Live streaming.
Question, I've not seen the questions.
Have you done?
Live streaming next year.
Oh, live streaming. Aha, I thought you said screaming. Live streaming means that if you really wanted to, you could stay at home and watch it on your computer.
Is that? Yes, sir.
With local authorities and other organisations being asked to have ever tightening budgets and reducing the permanent staff by contracting out services, what effect will this have on the pension fund?
All right, could you answer that?
Yeah, I mean, we've seen this over the last few years, and as highlighted by the membership numbers. I mean, ultimately, as numbers fall, the amount of contributions coming in is certainly going to reduce, and that can then eventually put pressure on employer contributions going forward, because there wouldn't be enough money coming in to guarantee the benefits paid. And I think that's some ways to why cost sharing is coming up again now, because there's going to be a limit to which you can ask employers who are already struggling to balance the books, etc. And you know, asking them for even more money would be counterproductive. So essentially, it depends on how far it goes down. As it stands at the moment, we're hanging around the 49,000 member mark. I can't see that, from what I know about the current year, that it's going to change significantly. But I suppose it depends on how local government evolves. As we've seen, you know, the thing with academies is you wouldn't have expected that they'd have all moved from the local authorities into separate employers and been running their own things. So the fund is totally different to when it started with, you know, if you remember, if you were here last year, I did a slide, I think we had 100 and odd employers right at the beginning, right up to 360. So it's knowing how policy will change and affect it, but it's a slow thing. It's nothing that will happen overnight type of thing.
Is there any more questions from anyone? it looks as though...
Quiz answers now.
Quiz.
Quiz answers.
Oh, the quiz.
Changing addresses. This struck me as a very high number, but apparently it's 11.5%. That surprised me. So it must be everybody moving down to London, I think. Squiggled. Right. Getting married. 290,000 marriages a year. This is a happy day. People living overseas, 994,000. Interestingly, majority of people tend to live around the Mediterranean or Australia, New Zealand, the old English-speaking world. Very few actually go up to Kathmandu or places. Deaths, mosquitoes kill more than anyone else. 750,000 people a year. Yeah. Well, I could argue that humans aren't really... humans on the same gauge, on the same survey, suggested 425,000. Which also struck me as rather strange. Shark deaths, apparently only 10 a year. So given the coverage you see in the press, maybe that's interesting. Dogs are quite high up. So if you do go abroad, get a rabies injection. Now, this is the investment nod question. It's 336 million bricks. Now, at 10,000 bricks a house, that's not a lot of houses. And bearing in mind what government says we have to build, yes. The trouble, interestingly, with the brick industry is that you mothball plants, and it takes ages to make them economically viable. So once you close them down, you need to be very, very sure you're going to make money before you reopen them. And that's one of the reasons why I'm afraid we're importing bricks again. Thank you, and go and enjoy your food.
Oh, just a minute.
Oh, sorry. Sorry, I forgot my chairman.
Well, I'm sure you'd agree with me that these two particular people and their departments which they represent and has been doing an excellent job. A few things what's come out tonight which is very, very useful, and our job is to pay pensions, and it's our responsibility. And before we pay pensions, we've got to do something about getting some revenue in. It's also been mentioned tonight that we're talking about a £5.77 billion fund. It is locally managed. It's one of the, I think it's one of the top 5 in the country. It means that we're in a position there that, because we can get the monies in and we can invest. Now, our particular team at South Yorkshire Pensions, by none, are absolutely incredibly successful. And it's been a pleasure and a privilege to, along with my fellow councillors and friends, to work with them as well, because at the end of the day, we've got to pay some wages out, and that, before you can pay something out, you've got to get something in. And that's apart from contributions, and it's about investment. You've seen the slides, and it's very complicated, it really is. You've seen the slides which John put there about UK equities and international scenes, and it is so complicated, but it's so good. And it's run locally, and it's run by local people, and it's run internally as well. So that means we're not paying extraordinary amounts of finance out to investment. So when you talk, in fact, you've had some free advice from a financial bloke. You want to take that for granted because you don't normally get that, But this is what we've got. We've got an excellent team, a brilliant team at South Yorkshire Pensions, and Gary mentioned there about the perfect storm. They've hit us this year with everything you could possibly want about new legislation on what we've got to do and why we've got to do it. All right, it's our particular forte to do, it's to do what we're told to do. But what we do is we put a good case up, about where we can go and why we need to do it. And I mentioned about the Iceland banks. We've got all that money back there. There's about 180 billion pounds of money circulating within the United Kingdom and beyond in collective assets. There's 4,700,000 pensioners being paid. So all this particular government initiative is for efficiencies, cost savings, and so on and so forth. And there is a lot to be said about that, and we will do a lot about that. One thing I want to mention briefly, and I mentioned by John about responsible investment, and our particular role as trustees and members of the board is to get the happy medium. Now, out there's trauma about environmental issues, all about tobacco issues, they're all about sweets and no good for it. It's about the investments and what we have to invest in for returns. But we take everything into account and into consideration, and we don't do it lightly. And we're not allowed to do it lightly because there's new government legislation come out to say you're not allowed to that. You've got to take it into account, which we do and we will. So it's a little bit of a dilemma, but we are getting there on that particular point. So as far as I'm concerned, there are a couple of firms mentioned there. Shell of 82 million, HSBC 68 million, and I know tobacco, British American tobacco, that's about 78 million. It is mega bucks and it's a lot of money, but at the end of the day, we pay pension finances out, and before we can pay out, we've got to get it in. So the fund is running extremely well. We had, less than a month ago, a particular lady came to speak to us at South Yorkshire Pension. That's after we'd been to London to have a word with our investment advisors about various options we can take. And her first words were, "You've nothing to worry about, everything is all right." So as far as I'm concerned, as your chairman, I thought, well, that'll do for me, So what we did is we assess, we evaluate what the situation is, and we come to a decision. So that's to end on a good point, There's not a lot of anxieties there, but we will not rest on our laurels, and we need a job to be done, and we're trying to do as much as we possibly can. I don't need to say any more than that, just to end on a positive note. It's been mentioned that there's light refreshments will be, if you care to have them, you're more than welcome. And thank you so much for being a kind and wonderful audience. Thank you for coming to look at our stadium, and thank you for being with us here tonight. Thanks very much.